I've been waiting a long time, but I finally did it. I put together the best advice on traders for the past year that I've interviewed. We're talking real traders who are trading full-time, making a living, and some of the best traders in the world. And you'll get to hear today their best advice and their best lessons in this video. Let's dive right into it. So I host a podcast where I interview traders. I talk with traders almost every single day. I ask questions, I get to know their stories, get to know how they become successful, what things help them to maintain the success, and what they do to get to that next level in trading. And I thought it would be really cool to pick out the best advice from these traders over the past year or so and share them into one single video. You'll get to hear from a taxi driver who cracked the code in trading, from a trading psychology master, and some 50 years market veteran. These are all legends in their own field of trading, and we've picked the best advice that they share in these interviews and put them here in that video. Okay, so if you're ready, let's dive right into it. And let's go to pillar number 1. Traders we interview know that you can have the best strategy in the world, but if your mindset isn't right, if you don't think the right way, or if you don't see the right vision, then the results will not come. So here's what the best traders know about the mindset of trading and what it takes to become successful long term.
The mindset, first of all, I think it's got to be like a passion. I don't get up in the morning and feel like I'm going to work. I get up in the morning and this is what I do. It's just like something I live and breathe, and I just have fun doing it. So if somebody feels like they're fighting it every morning, you probably should be out of the business, So the mindset has to be, on the one hand, you've got to find a strategy that works for your personality. I'm always telling guys, like I'm sharing information every morning. And I tell my listeners, I say, or what I like to call portfolio managers, I literally ask them, think of yourself as a portfolio manager. You're not following smart money. You have to be the smart money. You have to take the initiative. But I guess I try to say to them in the morning, you just have to almost be like, while you're building your own strategy and doing your own thing, you also have to, in order to survive in this business, you got to be a little bit like Bruce Lee. Bruce Lee, you got to be like water. You got to be like water. You got to be able to shift and move and understand when your strategy doesn't apply to the market you're in, which can kind of bring us to what's happening right now in this market. I'm carrying tons of cash. I'm just trading around the edges of my portfolio because any strategy written for a normal market will not work in the market we're in right now, which is one driven by geopolitical headlines that come out in social media like rapid fire and totally conflicting. So you could put on a great day trade right now that would work in a normal market where you've written a strategy for a normal volatility market, and you could be on a trade. It works great. Piece of news comes out in 3 minutes. That trade's buried. So while that's true in any environment, it's like ridiculous right now. So I guess the long-winded answer to your question is you've got to be a little crazy. You've got to be committed, and you got to be like water. Otherwise, you don't make it. Yeah, you don't make it. And I guess the last thing is, what? The guys who get blown out, they don't know how to manage risk. You have to start by managing risk. Then you figure out how to capture upside. And the average individual investor or the new guy trying to trade or the new person who's just started, they have that equation upside down. They're trying to capture upside and they're not even thinking about managing risk. And that's why they get blown out of the business. The best guys in the business know how to manage risk. I don't play poker very often. Okay. But when I do, I go to Vegas, whatever, I'll play Texas Hold'em. And every time I don't play it religiously, but when I do, every time I get to the final table, the guys around me at the final table of a tournament, let's say in Vegas or wherever, most of them are in our business. They're bond traders, option traders, equity traders. And the reason is we all understand managing risk and probabilities. That's what keeps you in this game longer. The guys that get blown out don't know how to manage risk, and they end up not having the ability to stay in the business.
Because, when you ask yourself a question, why am I doing this? Your brain is going to come up with answers to it. It's very literal. And so if I ask myself, why am I just screwing myself over? My brain's only going to come up with negative answers like, well, it's because you're a loser, or because you just can't control yourself, or because you're a bad trader, or maybe it's like because I'm too nervous because I don't think I'm going to have enough money to retire. But what you really need to be asking is, how can I do something different? And what I try to do for people, Etienne, is I try to get them to avoid that battle in the first place. If somebody has a really bad trade and they just can't get over it, and maybe even not consciously aware of it, but it's still in here in your heart, what we can do is we can have the person remember what happened, but they don't have to talk about it. And then you have them rewrite the story, and it just kind of goes away. But the thing about the eye movements is what really makes it work. You know what? It's really like hypnosis, but there's no trance. So, like, imagine, there's been plenty of people out there who've gotten a lot of help with eating, and they go to hypnosis and then they just don't really have that urge like they used to. And that's what I do for people is right where the rubber hits the road, I help them so that they just don't even have that urge to overtrade or to, be scared or whatever it is that is their problem at the time. Yeah, there's some people who are just so angry and they're trading in order to prove something. And usually it's something really big. It's subconscious. Like they're trying to prove that they're a good person, or maybe they're trying to provide a really nice life for them and their family. And for them, it's just hard not to see it as like a big, huge statement about who they are. And they really get invested in the outcomes, which is really unfortunate. I mean, what people should be focused on is their actual process and their decision making. And then, of course, you can never really know if you did the right thing because there's a million factors at play. So when it comes to people that really can't respond to the type of therapy I do, it's usually because they just can't get over their anger. And I mean, it's easy for me to say that when you're angry, it's like you're taking poison and you're hoping that, something else will get sick. But a lot of times they just can't let it go. So, what I tell people, Etienne, is if you're really mad about something that happened, what you're doing is you're not accepting reality. And what I try to preach is for people to actually feel sad instead of mad, because if you feel sad, it's not good. And of course, what you're doing is you are accepting reality, and the reality is that you were powerless and that you are powerless to change what already happened. But when you're angry, it feels better than sad, because you feel this sense of power, and you're like, well, it should have been this way, and I should have done this, and it just should have been happening. Well, you're kind of shoulding all over yourself at that point, and living in shoulds doesn't really work for anybody. If you can actually quietly accept what happened, then you can move on. But if you're angry, you really can't. So, I mean, easy for me to say, but I can really help people to take the energy out of that whole cycle.
But so now we need to look at the trader who has almost like an internal conflict. One part of him or her, the trader, is looking for, I want to be a successful trader, I want to build a trading career. But there's another part that has a different need that then overrides that. And this need, this is what we need to find out. What is it in that moment that becomes more important for the trader than being successful? And so what happens is that, for example, I had a trader who also, so he has a strategy that shows him a little error when he should take the trade. But very often he was front running the trade. And then we looked at, so why is it that you're front running the trade? And the old same story. It's like either I was worried that I missed the entry, or I thought I can make more profits if I enter earlier. And then, of course, most of the time it doesn't work out this way. So what was going on for him was that he had or still has an alcoholic father. And this father had a military background, and he was very controlling. And he was controlling in a way that was very painful and harmful to this trader. And this is why he found it incredibly hard to follow his own instructions, because unconsciously there was this really big resistance against being controlled and follow instructions. Like, if you could consciously think about it, it doesn't make sense. Like, when I have my own strategy, no one wants to control me, but this is really how the unconscious experiences it. And only when we found out what was going on, and the way we did that was, okay, so tell me, what is your internal representation in that moment when you front run the trade, when you enter too early? An internal representation, Etienne, is our senses that we use in order to get to a decision, also called a strategy, right? So we all have a strategy on how we do things. And the strategy, which is now neuro-linguistic programming, the strategy is maybe, let's say, we go and buy a T-shirt. Someone goes into the shop, then they see the T-shirt, so we use the eyes. Then they go to the T-shirt and they touch the fabric, so that's a feeling. Then they say to themselves, "Oh, I like this T-shirt." Then they take this T-shirt and they go to the cashier and buy it. Right? So that would be a buying strategy. Now, for everything we do in life, may it be brushing your teeth or being on time, running late, we have a strategy, an unconscious strategy. And we want to bring that to the conscious awareness. And so I look at what is the internal representation this trader has that leads him to the outcome of doing the thing that he is not supposed to do. So if I say I can't be disciplined, what I'm saying is I can be not disciplined, meaning I have a strategy unconsciously on how not to be disciplined. And now I look at what is going on for you. So what's the first thing? Is it a feeling? Great. What's the feeling that you have? And then what's the next internal representation that comes? Do you say something to yourself? Or, I shouldn't feel this way. And then what is it that you think about that feeling? Every time I feel like that, I'm going to mess up, right? And so now comes the lack of self-trust, the lack of confidence. And what we often unconsciously do is we try to live up to that lack of confidence, because most probably was instilled from someone, one of the grown-ups that were in our lives at an early stage and told us that we are not good enough. And unconsciously, we still live up to that belief that was installed in us. And so you can see it's not that straightforward. It's always like a little bit of context that we need to bring into why is it that I don't do what I know I must. But then once it's figured out, it's easy to fix. And AI can't do that as yet.
What happens is that many developing traders begin trading way too early before they have figured out their strengths. So they read a book or two, they watch a video or two, and they look for chart patterns or indicator signals, and they start trading, putting their money at risk. And of course, they're not prepared. They lose money and they become very, very frustrated. So to succeed, you really have to figure out what your strengths are first, and then see if you can apply that to different approaches in the market. For example, the strengths of an active day trader who's getting in and out of the markets. The traders I worked with in Chicago, the average holding time was 6 minutes. So they're not looking at long-term charts. They're looking at order flow and who's buying, who's selling, how much is for sale, and how much is being lifted. Others are not short-term traders. They're longer-term investors. The short-term trader is a pattern recognizer. That's what their strength is. They're good at recognizing patterns. The longer-term trader is very good at analysis and figuring out bigger picture patterns in financial markets. In fact, that's why hedge fund managers hire analysts, because they're analyzing opportunities, often in a quantitative way. Very different strengths, very different skills. And the important thing is that we figure out what we're good at so that we can leverage those.
The takeaway from this is stop looking for one thing or one tool to solve everything. Trading success comes from many small shifts over time that make you successful, not from one indicator or one key thing that you change one day and then you become successful from thereafter. It's a series of small actions, small tweaks every day, and consistency over time. You cannot just show up one day and become successful. You have to apply things every single day, little by little, to get to that end result of trading. And please understand that risk is part of trading, and the way you manage it and the way you understand risk is a big factor into your success in trading. All right, and that brings us into pillar number 2, strategy and adaptation. Once you have your mind right, once you understand the mindset of trading and you know how to think, the next step is being able to adapt to the market. Having a strategy that works for now is good, but it's going to have to work for multiple years. And all traders will say that the best way to succeed long term is having a strategy that you can adapt to the market and being able to spot these patterns or these changes in the market before they appear or right when they appear so you can shift to a different style of trading. And here's what the pros have to say about this.
Many of the concepts that you see online, they are valid, but they depend on how you apply it and who is applying it. Many times, strategies that you see online from people, for example, we have multiple strategies which are the way from scalping with Jean-Francois and all the way to manual trading, and we have swing trading. We have different programs focused on that. And most of those things work. We have members that have work, but you can also see that we have some members that are unable to make some of those strategies work because they do not fit how they see the market or how they apply the things. So for me personally, price action, it's valid in the markets, but it's very hard to get proficient enough to get past that hurdle of proficiency where you can execute with like steadily without having that much of those discipline and mindset issues for traders. So if a trader is trying to learn, it's a very big hurdle to pass sometimes for price action trading. And indicator trading and other more parameterized methods in which you have more rules and you have different ways of seeing the market, which are a bit more objective. You still have some subjectivity, but there's a bit more objectivity in analysis. I think those ones tend to be easier because it's a lot easier to look at an indicator or to look at something. Now, when I apply those things to algo trading, part of the core of my algo trading career has been trying to implement some of those price action based or discretionary aspects that a trader may do in their manual trading and trying to apply them into algos. So that's part of some of the advanced filters that I have developed. And those type of concepts are some of the things that have helped my algo trading to improve, which is taking concepts from price action trading and from manual trading into the algo world. And if you are interested in that, I will be having a video about how I applied those and how maybe you can also apply those into your own trading.
Yeah, I do have a journal. We do have a journal at Trading Terminal. We build a journal for our traders, and journal is the most thing. But the most important one is your equity curve. You see how it's going. That's the final, thing that you look at the mirror. You see, okay, am I fat or not, or your equity curve is going up or not.
Right.
I have stopped improving my strategy for a few years now. I'm trading in the last few years, same strategy. The only thing that I'm trying to get the better result is using leverage better. But my system is still the same. So what do I mean by leverage? So you can trade Tesla, or you can trade Tesla on leverage, or you can trade Tesla options, calls or puts, or you can trade TSLL or leverage products of it. So use of leverage can magnify your return. So I'm playing around with how to actually can use the leverage to increase my profit.
Right.
But the downside of that is that leverage can also wipe out a lot of your gains as well. So I'm playing around with that. I think my biggest losses have always been from one or two bad trades on excessive leverage.
Right.
So I have 99% of my profits coming, and that 1% is just wipes out years and months of my profit. So sticking to that maximum loss or working on yourself, accepting that trade didn't work for you, I think is very important. My system, if it's my system that's not working, very small losses shows that my equity curve is low. But if my system is going up and then suddenly a drop, it means that I have those risk management that usually comes from my mental, decision making is the problem.
So it depends on your, again, personality types. Day trading, you have to think of things quickly. You have to think of your money management quickly. You have to make decisions of beyond this point. So what happens in day trading is your brain needs to calculate odds quickly. So it's like when you go to the casino and you're playing poker or you're watching TV, and you know how when you see, or let's say you're going to bowling. Everyone knows bowling, right? You're going bowling and there's 10 pins in front of you. When you start the game, it's like, what are the chances of you making a strike? Well, if you're going to take a 40-kilogram ball, then the chances are very low. But if you take a kilogram ball that is suitable to you, there's some chance out there. Let's say you hit it, the whole right side, all the pins go down. Now you're about to go again. What are the chances you're going to knock out the rest? It's still pretty high. But if you make it where only there's one pin on the right side and one pin on the left side left, what are the chances that you're going to make it now? Your odds have decreased dramatically. So when you're trading, and as the trade evolves, your brain is saying, ooh, now the odds are not in my favor. Now the expected value has shifted. It's not the same anymore. So you can have a perfect hand for poker, like you can have, two kings, and then as each card unfolds, your odds change. So the market is no different. As the market evolves, your odds of what you're holding on to evolves too. So in swing trading, you have a lot of time to think about that and saying, things still look good, let's keep going. In day trading, it's like you got to be, no, not anymore. Things are good or things are better. Size up, size up. You got to be quick on your feet for that stuff. So if someone is starting out new and wants to become pro, I'd say even if you fail, start out as a day trader. And that's a very controversial thing to say, but even if you fail, start out as a day trader. Get your brain thinking in terms of odds quickly. And the only way to do things quickly is either you back test the hell out of things and you do 500 examples sitting behind a screen, clicking next, 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 or you do it real life and then you do 200 of those in real life for the span of 1 year. And you will know what needs to be known very quickly. As long as you do some recap and post-analysis every day, you can become a good trader in less than a year's time, very, very quickly, even if you're a losing trader.
Yeah, so that's where AI comes into handy. So we throw in the AI will not really going to predict whether what is the support or what is the resistance. And neural networks are very good with that. And lately we even employing large language models to predict the movement of the market. So basically we will have an algorithm, and you obviously, based on your taste, you will have your stop loss and take profit in your mind or in your strategy. And then you train your AI on a historical data on the same asset class, same time frame, very, very large data. And then you, after that training, you ask is the probability of hitting your stop loss. And if the probability is really high, maybe it's not good to go into the trade. And obviously, you test these algorithms beforehand. For example, you can train on 2000 to 2024 data as your training. Then 2025 data could have your validation testing set. On unseen data, you test it on that. And then on 2026, then you can start doing the real trading after you have a confidence on your completely unseen, untested data. You test it on those data set, then you can start
employing that into your real trading.
It is, and the thing that I didn't realize actually when I set out on this is that it is absolutely possible to completely curve fit an AI model, just like it is. So you've hit the nail on the head. So you have to take the same kind of precautions when training an AI model that you do when performing an optimization in the more classical sense of algo trading. And that, I think, is one of the reasons, actually, why feeding less information and less data into the model helps with this. Because the more information you feed in, it's just like when you perform an optimization in the classical sense. If you optimize 20 parameters in an optimization, the optimization is going to find a way of curve fitting to past big market moves. Okay. So for example, in its extreme case, you'd find if you optimize 20 parameters, it would always be on the right side of a non-farms payroll release. It would always be on the right side of a Fed interest rate decision, things that really tend to move the market. And it will always find a way with so many parameters to be able to do that. So it's effectively curve fitting those past events that bear no relevance to what's going to happen in the future. So with any optimization, what you want to be doing is you want to be targeting not past big events like economic news events. You want to try to and find a way of targeting the edge that the strategy has. And that's a really fine balancing act to do. But just like with any, with an AI model, if you feed it lots of data, that too will just curve fit to those big events that effectively are random, right? Because we don't know when economic news is released, we don't know if that's going to have a positive impact on an asset or a negative impact. We don't know if it's going to make the price action go up or down. If we did know, we'd make a lot of money, but we don't know before the event which way it's going to go. So it's effectively random. So if you curve fit a model to those random events that are never going to repeat in the future, you're going to put a model live that doesn't make money and at worst case loses a lot of money. So you have to focus on the things that are repeatable. And the things that are repeatable is the strategy's edge that you've tried to develop. And it's no different for AI.
All right, so key point from this is that if you're not adapting to the market, you're getting left behind. And it's not just about the market context, but it's also about new tools, new technology you can now use to become better. Now we have tools like trading journals, like AI, like other platforms that can help you to trade better. Why not learn these tools correctly now? Why not use them correctly to help you get an edge in the market? Because at some point, everyone's going to use them. And if you haven't learned them before, you'll get, of course, left behind. This is different than falling from the hype or trying to go and catch the shiny object all the time. It's about learning to master skills that will serve you for a long time. And now that brings us to pillar number 3, the longevity secrets. What makes it that some traders quit after 3 or 5 years, and what is it that some are in the market for decades to come? They're in it for 50 years or more. So I want to ask these guys who've been in the market for 30 to 50 years, what the secret is to be able to be that long in the market, and what is different from them versus the people who dropped out after 3 or 4 years of being in the market. And that's what they had to say.
Well, I've always been one to say you got to be patient. You got to wait. You got to let that market move. You got to let that market breathe. And like I say, it's not a race to break even, because the minute you have a race to break even, again, you've got to expect that the market may very well come back to test that level again, just to see, in that example, is there still more buying than selling? If there is, okay, well, you just keep going up then. So, yeah, not a race to break even. But again, it's about being patient. It's about letting that market move. It's about understanding how a market moves. And a chart will tell you that, is this a sort of a market that moves quite rapidly? Is this one that moves a little bit slower? Again, if you learn to recognize how a particular market moves, then you can, do things accordingly. So if you were to look at a highly illiquid market, you would understand that would be up and down very, very quickly. Or if you looked at a more liquid market, it could take a little bit longer. If I'm looking at the month of December, then that would be a month that I wouldn't really want to trade, because I understand that there's going to be book squaring, there's going to be profit taking, all that kind of stuff. Like I say, you're not going to want to risk what you've made between January and November. Would there be sort of a scenario where I would say I'm not going to trade a particular range if it gets there? Maybe a US election, obviously, because I know that that can have a very big impact upon markets. Maybe going into a holiday period. Maybe, again, you don't want to be, sort of trading. But I mean, again, I'm not scared, really. I don't let the outside world sort of really influence what I'm doing, because I'm like, right, I'm at that price. I've been afforded an opportunity to take a trade from here because the market's got to where I want it to be. So, yeah, I'm not too scared to, put the money on the line and say, right, let's take this trade. If it works, it works. If it doesn't, it doesn't. That's, again, that's another scenario of, right, well, if it gets back there again, I'll have another go. If it gets back there again, I'll say, right, okay, well, maybe the market at this particular time can't make its mind up about the current value. So let's just leave it alone for a little while. Let's let it at least move, maybe sort of say halfway between the range, because then I can see that it's moved away from this particular price. And then if it gets back there again, then I'll take it again. But again, it's just saying to yourself, you are insignificant inside of the game. You can't influence how it works or where the market's going to go. So if you're afforded an opportunity, in my eyes, take it. A very tight range. Well, I would suggest that the ranges that I would sort of set out would take days, if not a couple of weeks, to complete in its cycle to go from the bottom of the range to the top of the range. So, yeah, I mean, on occasions you will have sort of days where, it's quite crazy and, you can just sort of do a whole range in a day. But yeah, the ranges aren't that small. So it's like I say, it's more patient and disciplined trading, but it's taking a step back and just realizing, less is more. It's not about how many trades I take. It's about the quality of the trades that I'm taking.
You have to want it internally, right? Whatever you want inside your body, you have to be able to manifest that in your behavior, right? 2, the markets also change. They morph. And it's just the natural order of things. The market is a living, breathing mechanism unto itself that really adopts and absorbs all the information and all the participants' activity by definition. So you need to, it's like, I'm not a big poker player. I can play casually, but, you have to play your cards, but you also have to play the table. You have to play the people across from you because they can bluff. The market doesn't bluff. But so you need to know your environment. 2, I think self-knowledge, despite needing to have technical skills, self-knowledge is probably 90% of the game. We don't get paid to know stuff. We get paid to execute. So the minute you stop being able to execute, you need to take a time out and go back inward and say, okay, is it me or is it the market? The best thing a person can do, because that's a loaded statement, is chart your equity curve, just like it's a chart. And is it going up? Is it going down? Is it going parabolic? And figure out why. Are you in silver and gold when the market's going parabolic so that you see in your own equity go? Maybe that would give you an indication that you might want to trim your position. If you're in a big drawdown, are your positions too big, right? Are you trimming your equity? So there's a lot that's going on in that question. It's usually starts with the individual. Why? Well, because no one's holding a gun to your hand to have to trade. You typically want to. Second chapter, my book is called Surrender. And it doesn't mean weakness. It just means you need to know the situation. There's times to bet big and there's times to sit on your hands, right? And that's when you're in big winners, let them run. And 2, if the market's not amenable to your trading style, it's okay to sit out and let that pass, and just chill and come back at a better time, because the money you don't lose, you don't have to earn it back. Again, in my mindset, Etienne, it was because I knew I needed to have a marketable track record. So I was always hyper aware that my activity is going to be reflected on my P&L. So I had a clear vision. Again, I was either going to work in-house and run firm money and get paid out on that, or I was going to take my client money and go out and start my own company and then get paid like 2 and 20. So I had a clear vision. But everything is evolving. I don't think, people talk about journaling, meditation. I tend to write things out. I got red and mostly blue. I like to, for the neuroscience of it, I write in blue, and I have 4 notebooks here. Each one has its own reason. I don't mingle everything, commingle. So I think the onus is on the individual to kind of continue to learn about themselves. Also, life evolves. When you're young and single, you have no money, but you have a lot of time. When you get older, if you're successful, you're going to need to spend time with your spouse. You're going to have time with your kids. So you have a lot of money, but you don't have a lot of time. So you value things differently. Right now, if you're 26 and you're on a trading desk, go for it. Crank it while you can. Because in 10 or 20 years, you're going to have a spouse saying, honey, we got 2 kids. You can't be looking at your charts at 11 o'clock at night. I need help getting the kids down. If you want to stay married, you're going to have to learn how to change gears, and be a team player in many ways. So you don't know that when you're younger, right? Because you can't foresee. You can have an idea. Yeah, I'm going to get married. I want to have kids. But once you're living that information plays a big role in the way you trade. Are you a morning person or an afternoon? Are you active at the open? Right here it's 6:30 for stocks, at least the outcry. So if you have kids who are getting up trying to make their way to school and you're trying to day trade at 6:30 in the morning, this is a bad culture. Your household is actually a bad culture for what it is that you're trying to do. So you have to break up the day and say, okay, your spouse and the nanny might handle the morning. You're going to handle pickup and after school, homework, snack, and then baseball. So there's all that goes on into it as well. So there's internal and external forces that are constantly evolving that you need to keep up with. The best people find a way to make that work, probably because they're good communicators.
And my wife and I have been full-time equities traders since the 90s. So the gist of what we're doing has always been the same. I wrote a bunch of books about trading. We're both PhDs. We're both researchers. We did a lot of research on the markets while we were in graduate school. And the foundation of what we did was all in statistical analysis. So we did a big multivariate analysis of covariance on New York Stock Exchange data. And then we built a trading model around that. And we've been trading that, for going on 30 years now. Probably added, NASDAQ was the last thing that we added to the mix. And that was 12 years ago. And the current focus is it's still on all those patterns. It's still on, we're order flow traders. We go through, we try to isolate order flow in the markets, figure out where things are happening, where things are likely going based on where the orders are piled up. And then, over the course of the day, it's just our job to go and pick off the liquidity. And, the primary focus of the thing is on the first hour of the day. So our big emphasis has always been, the 1 hour trader. Trade the first hour, and then really the rest of the day should pretty much be something you can automate. Early on, the guys who I spoke with and who I learned to trade from were not people who were doing online trading or were doing investing. They were floor traders. So there were some really good influences, $2 brokers and guys who were specialists at the exchange, and people who worked that side of the market makers, the guys who are putting together order flow. And it was really just by getting a feel for what they were telling us that they were doing that we then turned around and said, you know what, you can take all the statistical stuff that we did, take all this stuff that was able to be quantified, and turn it into effectively pattern recognition, where you're going through and you're looking at charts and finding. The first book I wrote was originally called A Multivariate Analysis of Covariance in the United States Equities Markets. And the publisher said, how many copies of this thing you think your mother's going to buy, because nobody's buying that book. Nobody's buying a book with that title. So we renamed it, rebranded it Around the Horn, A Trader's Guide to Consistently Scoring in the Markets, took the statistics out of it, left the pattern-based stuff in. And to this day, an expansion of range and volume pattern in there is called fast vol. An extension reversal is called infield fly. And as we develop those, there's the 12 patterns in that. The book's out of print now. I mean, it'll be back next year with a much heavier emphasis on psychology. But the patterns that are in that book are still the things that we trade today. I mean, markets are cyclical. We follow market cyclicality. We follow, the natural markup, markdown, and accumulation, distribution, all the stuff everybody knows. We're just following that and looking for the footprints of money as they move through the market, and then trying to figure out, where are the big players likely to take a stake tomorrow based on what they did today. So based on today's price action, where do we think they're going to step back in and finish what they were doing, or just reassert order flow, and how can we capitalize on that? That's been our gig.
A lot of traders or newer traders have a misconception, right? They just pick one and they think this is the strategy, and that's great, and they develop those skills, right? So I think someone that's been around longer, has more experience, you start to add different styles, right? But for the first person just starting out, obviously it's important to really find a style that you're aligned to, and then really focus on learning it and getting the experience and building up the skill set, right? A lot of people, they think you just jumped into trading and you know how to do it and it's easy, right? So, but as you know, you got to do a number of trades, you got to learn lots of lessons, you got to have that experience with the actual, trading itself, until you get and that's where either you find out whether you have a skill for it or you don't, right? It's like anything else. Like a lot of people try to learn an instrument, or they try a new sport, right? And they try it, and sometimes it's works for them and sometimes it doesn't, right? So I think your question about, do people have different styles? I think that's more, I would call them more professional traders. Like they're doing it seriously, they're trying to make money off it, and they've got the skills, and they're developing multiple approaches to the market, right? And then there's others, even professionals that just have one style and they stick to it and it works. And a lot of people leave because they realize they tried trading for all the wrong reasons, right? They had all those unrealistic expectations. They don't know what's really involved, and they don't understand the work involved in order to become successful. And so they leave because they're not willing to put in that effort, or maybe it's they thought they'd try because they were told how easy it is, and they just don't have a passion for it, right? I think the people that are around for longer terms, they either knew when they started or they quickly learn what the realities are. I think you need a passion for trading. It's like any other, whether it's a sport or any other thing you want to learn. If you're not interested in it, you're not gonna stick around, right? Like I think that's where once people get that reality check, they just say, okay, I thought I was going to be a millionaire overnight. What's going on here, right? So they walk away, right? So, and then I think the other thing that people don't think about is that it is a skill to trade, right? And that skill is, being able, like, think of all the components. We talked about, not having a boss, but the other thing is it's essentially you're running a business when you're trading, and there's all sorts of different components of that, right? And there's lots of work involved, like administratively and, developing your skills, et cetera. And so one, they're not willing to put in that effort, or when they do it, they realize they just don't have the skill, right? Like there's nothing wrong with not being able to trade, right? It's like some people can do it and some people can't. They don't have the temperament for it, or again, part of another unrealistic expectation is this ability to make a lot of money with very little money, which when you understand the mathematics of trading, it's just either you really got to put on some high risk trades or use leverage, and then that's a double-edged sword that most people get wiped out. So a lot of people also leave just because they lose their account. So, and then there's a lot of traders also that are in it just for the gambling aspect of it, right? So they're not taking it seriously. It's more like a casino, and then they just keep plowing money into it, and eventually they get to a point where they're like, I'm not doing this. I'm not funding this anymore, right? They're still sort of looking for that one trade that's going to make them a ton of money, but they don't really look at it realistically as far as, okay, how can that actually happen? Because you're trading something that, doesn't move that much. And so how do you expect, $1,000 account to become $1 million in 30 days, right? So anyway, I think that the people that stick around are passionate. They love the business, and they're willing to put in the time and effort, and over time they become consistently profitable, and it's a way to make some money, right?
And trading for this long is not all sunshine and rainbows. There's going to be traps or factors you got to be able to avoid and be careful about. And I want to include some obstacles here that you can face in your trading journey that could affect how you succeed long term. And if you know these exist, you can try to avoid them before they come up.
massive risk. And that's where the biggest misconception comes in, is that people are always enamored by the data points that say like 95% of retail traders fail. And they think, well, if that's the case, let me spin up a prop firm, because they'll just pay to take these challenges and they'll fail, and it'll be like printing money. But the reality is that prop firm workflows create what I call asymmetric risk. So I might sell a $100,000 challenge for $500, and maybe only 5% of traders pass. But when that 1 out of 20 traders passes the challenge, he now has a $100,000 account, perhaps with 50 to 1 leverage. And it doesn't take a lot of trading in the right direction for that trader to make more money and be due a payout that outpaces all of the challenge fees that were collected. And so you have to understand that this asymmetric risk exists, and it is not just a sales and marketing game. And that's the biggest flaw in the thinking of pretty much every prop firm operator out there. And I suspect that if you took a snapshot of their business right now and said, you're not going to have any more prop challenge sales coming in, and then you look at their bank account and you look at the total value of liabilities on the books that they have between funded accounts and challenge accounts, that some percentage of which will become funded accounts and earn payouts, that they're insolvent. So again, I think 95% of prop firm operators out there are insolvent, and they are relying on selling challenges to cover their existing liabilities, which basically creates a vicious cycle that they never get out from under. It really only gets worse the more that they sell, because they're creating more and more liability as they go. And so you really have to have a keen understanding and appreciation of the risk side, and you have to have ways to detect different types of abuses and toxic trading and arbitrage, and have the ability to hedge exposure in a variety of different ways to really run profitably and successfully. And so I do caution most operators out there that think this is just a path to easy money, that it really is anything but. And the prop firms that have come and gone over the last couple of years should be a cautionary tale. You want to look to those firms that have been around for a really long time, that have great reviews out there, that aren't just on Trustpilot, because that's something that can be easily gamed to make a firm look better. But firms that have been around for several years, that have sensible rules, are probably firms that you can rely on. Because if they have been around for years and people are still trading with them, that means that they've weathered different storms. They've weathered challenges with platform providers shutting them off. They've weathered challenges with very challenging or highly volatile markets where, certain pairs or products that people trade actively, went on big runs, and that could have crippled a smaller or undercapitalized firm. So those are other ways to just find a quality firm that will pay you out. If I can push our brand a little bit, our propaccount.com offering is our own white label brand that uses our technology, that's backed by our tech. You have been a partner of Prop Account going back years. One of the things that I'm most proud of with that business and brand is we can enable our partners to have their own branded prop firm offering, and we back it with our capital. And in the 5 years that we've been doing this, we've never denied a payout. And I think that's important. So for those, looking to you and desire to trade, they could certainly trade through you with confidence that they're not going to get screwed.
Now, I work with levels to take profit, but at the same time, you might be sitting here, you might not have much time, and so you might think, okay, that will do. I have this thing. I'll get to a point, that will do, and I'll just cut out of everything. It's not always a good thing, because then, of course, you come back an hour later and you think, I could have made double that. I could have made double that amount. So I wouldn't say it's a fault that I've got. It's just the way that I am and the way my lifestyle is at the moment. But again, sticking with that having that discretion, and something else as well. You haven't got a boss looking over your shoulder saying, "Oh, you should be doing that or you should be doing this." Mm-hmm. You're working with your own mind, your own way of doing things. You're looking at a profit on the screen and thinking, "Okay, that'll do." But realistically, especially when you're starting out, stick with the rules exactly.
Yeah.
Stick with the targets. Go for the targets that are recommended. Work with your stop loss. When you get to a certain amount of profit, pull in. That stop loss becomes a price stop, so you're locking in profit, and just let it ride. That can hurt sometimes as well. Yeah. You know what it's like. You'll be taking a trade. You'll see it move up and up and up. You could jump out there, think that'll do, but you don't. Not when you're working properly. Mm-hmm. You move your stop loss up to become a price stop, and then you see a pullback and it comes back and hits that price stop. You could have made that bit more profit, but it is what it is, and you've got to get used to that. And the other thing is as well, losing that bit of money, even taking full stops, losing. If I don't know who it was who said it once, but it was something along the lines of, you'll never make a profit until you learn to lose. You've got to learn to lose before you can start making money. And that is so true, it really is. Because again, we know that, and I've done it. And I'm not this person who's jumped into it and did it all perfect and it's all great. No. You lose and you start over trading. You start to over leverage. You place bigger lot sizes than you should do, and you're breaking your risk management. And it's the worst thing you can do. I am saying don't do it, but I'm not saying you won't do it, because a lot of us, you got to try. Yeah, but he said that, but I'm going to try it anyway. Oh no, I've lost again. Oh, I've got to try a bit more. No, that loss, you're going to get these losses without a doubt, but it's not an overall loss. The bigger picture is what we're looking at, and we're looking at, a month, 2 months, 6 months, a year, and seeing how we're doing then. And you're going to see it. It's like this. It's like that graph. I don't know if you've seen it. It's a day in the life of an entrepreneur.
Yeah.
Okay, so you're looking at it, and it's like, I've got this. This is good. Oh no, that's not so good. Oh no, look, I've got this now. I'm taking control of this. Oh no, I'm rubbish at this. And that's how it goes. And with trading, you'll get that. It'll go up, profit, a little bit of a loss, bit of a climb, bit of a drawdown. And those drawdowns, don't let them rule your life. Don't let them rule the way you trade. It's part of it. It's part of the game. It's part of this thing that we do. Those drawdowns, those losses. Obviously, you start to see something seriously wrong in a drawdown. Then you've got to stop, maybe hold on for a minute and look at what you're doing, reassess what you're doing. But all the time, it doesn't matter how long you've been trading for, you'll see losses, but keeping those losses under control, and the overall picture should be an upward climb.
All right, so there you have it. This is a recap on the best advice I've heard from 2026, this year so far. There's a lot of good traders who've interviewed on this podcast this year. They couldn't all make it in that video, so if you want to watch these interviews, make sure you click on that playlist on the screen here. This is all interviews from the past year and even prior to that. There's a lot you can watch there. A lot of good advice. Click that playlist, make sure you like the video if you liked it, and send this to a friend that you think could benefit from it. There's traders out there that are going to be looking for that kind of advice. They want to learn from real traders. Send them this video, tell them to watch it. That really helps me on my mission to have more traders succeed. And I'll catch you back here in the next video pretty soon.